look at it from a randomized perspective, and that will give you a clear indication whether you've got a profitable system or not. But in this case, you can see from 100 different simulations, everything looks great. Hello there and welcome back to Statira Trading. Today we're going to jump into going over our own algorithms results Sequenti. First and foremost, we're going to go through some quickfire questions that you guys might be interested in and then dive deeper into other aspects of the results of the algorithm itself. Now I really hope you enjoy this episode and we'll get right into it. What was the total compounded return? The total compounded return was 1004.97%. What was the average yearly compounded return? The average yearly compounded return was 77.3. How many trades did it take? It took 6,245 trades. What was the win percentage? The win percentage was 45.28%. What was the max drawdown? Across the 13 years, the drawdown was 5.6%. What was the profit factor? The profit factor was 1.58. How many losses in a row did the system take? The maximum consecutive losses was 14 losses in a row. How many wins in a row? Maximum consecutive wins was 11 trades in a row. Okay, so I just went over some quick-fire questions that people may have regarding our algorithm, Sequenti. Now, I pulled up Quant Analyzer here, and what you can see is our overall portfolio. And one of the things I want to go over is our stagnation in days period. Now, this is something that people overlook when they test the system or trade themselves. Everybody is just focused on the results rather than looking at some of the most important parts of trading when you are in a drawdown. Now, this will tell you that it took 170 days between when our peak equity was at a high, and that's 170 days later, that's when it surpassed that high. Now, that might seem like a long time to quite a few people, but again, look at the end of year results. We're not focusing month on month. We're more focused on minimums, quarters. But again, we want to allow the probabilities to play out. That's why we risk so low. We risk 0.3% per trade. And risking that low means even when we're going through a losing period, our drawdown isn't getting seriously high like something you might invest in like the S&P. That can go down. That's been down 50, 60% in those periods. And it can take thousands of days to get back to, it's got stagnation days of thousands of days. So in the grand scheme of things, the algorithm, yes, it might have 170 days down, but that is not exactly bad as long as you have that long-term mindset. Think back to the video, short-term versus long-term. If you're investing in this system, you want to be thinking long-term because the rewards that can come from thinking long-term and using a system like this can be very beneficial. If you look at the equity curve day on day, and you're just going to get yourself frustrated, you're going to have, you're just going to go through all the emotions that people go through of money going in, out. It's just not good for you. So moving on, I want to move on to the equity chart of this. And when you zoom out, this is what the equity graph looks like. It looks like a steady increase in equity chart. But within that, there is, you can see there within our pink graph here, you can see that that's where the stagnation period happens. And yes, again, you zoom out and you think, oh, that's nothing. But at the time, that might seem like something. But this is where you've just got to have that long-term mindset, know your statistics, know your cutoff points. And if you have a strategy that has a 40 to 50% win rate, you know that X, Y, and Z losses can come in a row. So you just need to keep going and just execute your edge, because there will be periods where your trades will not work out every single time. It might take a while before it starts going in your direction. That's because the market cycles. Nothing goes up all the time. But what we can see here, though, is a nice steady increase in equity graph. And that's exactly what we have achieved here by diversifying into different markets. So we trade currencies, we trade gold, we trade the German DAX, and we trade oil. So to achieve this, we have diversified our portfolio to different areas. Now, another thing that I want to go on to is the Monte Carlo analysis. Now, this is very important when analyzing your algorithm or your trading system, because it gives you a different outcome. So let's run 100 different simulations. So from this 100 different simulations, we're going to go to the Monte Carlo chart and have a look at what happens. Okay, so from this, you can see many different outcomes of the algorithm. So what this does is it completely randomizes trades in a completely different order and randomly skips trades with 1% probability. So all this does is give you 100 different simulations of our algorithm. So we can see even after 1,000 trades, even the lowest one it looks like it's just in profit. So, to begin with, this one here, you can see this simulation 70. It wasn't doing too well, but after it, it gets lost in this mist of constantly going up. So you will get systems that will perform brilliantly and constantly quite a lot, but then you will get systems that take a while to get going. But once they do get going, we can see that this is the outcome. So the good thing when you do your analysis is you've got to understand over 100 simulations, it's never going to be exactly the same as what you test. But if you can do a Monte Carlo test and look at 100 different simulations, you can get a rough idea of what to expect. So you can even run 1,000 simulations in this as well. There's so many possibilities, and going deep, diving into different analysis, especially Monte Carlo, is very crucial for the long term, because instead of you being fixated on the result of one backtest, which is essentially what you build in your portfolio based on past history, look at it from a randomized perspective, and that will give you a clear indication whether you've got a profitable system or not. But in this case, you can see from 100 different simulations, everything looks great. So that is the results to our algorithm, Sequenti. If you're interested in any other stats, please just pause the video and have a look. The software used quant analyzer isn't perfect, so the Sharpe ratio is not the actual Sharpe ratio. They calculate it a weird and wonderful way themselves. But if you have any questions for us regarding the algorithm, or any questions at all regarding anything else, please give us a message across any of our social channels and we will be happy to help. Now, this algorithm does go live on the 28th of February this month. It will be available for a limited amount of people, so please, if you're interested, visit the website www.statistically.com and sign up for the beta launch. Now, if you're not sure whether it's right for you, our last video on YouTube was the EA assessment tool. Please visit that, watch it, and sign up to that tool, and it will tell you whether you're the right fit or not. Another big thing that we featured on, it just went live the other day, we were on the Alpha Mind podcast where Jacob, the other co-founder, was on it. So please give that a listen, and it will give you an insight into more about the psychology basis of a trader. Now, if you've enjoyed this video, please like, subscribe to the channel, and you'll get some more.